Hello everyone! Now that we have a better understanding of support and resistance, we're going to be contextualizing this concept with something known as trend identification. Being able to identify the market we're in will help us produce a bias for trading effectively. So let's jump right in and start with uptrends. Uptrends are interchangeable with bull trends, and the most basic components of a bull trend are defined by higher lows and higher highs. A bull trend forms from the imbalance between buyers and sellers, with demand putting upward pressure on price. In this type of trend, buyers maintain control and exert their strength by defending price at higher lows. This type of market lasts until a supply zone is met, where buyers tap out and suffer exhaustion. As an aside, exhaustion is essentially a pivot point where buyers or sellers lose control of the trend. This eventually leads to a break in market structure and a potential trend reversal. We'll explore market structure a little later in the next module. For now, just remember how to identify an uptrend: higher lows and higher highs. Let's take a look at an example. I've noted the highs and lows to make this trend very easy to identify. We see several higher highs and higher lows over the course of many months. And if we notice, a majority of these higher lows occur at instances where we used to have previous highs. This again is reinforcing that concept of SR flips. Now, let's switch gears and identify the other type of trending market: downtrends. In its simplest form, downtrends, also known as bear trends, are illustrated by lower highs and lower lows. This is caused by an imbalance between sellers and buyers, with supply putting downward pressure on price and sellers maintaining control. Supply will continue to overpower demand until an exhaustion point is met. Now let's take a look at what we mean here. Here we see a clear downtrend as price continues to make lower highs and lower lows. It's important to note that there may be several different trends within a larger trend, depending on the time frame being analyzed. We will be diving into time frame analysis a little later. However, all we need to remember here is that technical analysis is always contextual. As traders, our goal is to take positions in the direction of the larger trend at hand. The reason being is that the trend is your friend. The likelihood of a successful trade severely diminishes if we trade against the trend. It's similar to trying to swim up a running stream. You're not going to get very far swimming against the current, so just don't do it. We should now have a clearer understanding of the fundamentals behind trending markets. The other type of market is called a range-bound one. However, that is a topic Trip will be going over later in the module. For now, let's focus on the trend at hand and see if we can identify either of these two trends in real time. Here we have our daily Bitcoin chart. What do we notice at first? Well, we can see there are some highs and lows, so let's map them out. Here's our low. Here's our high. And what happens from here on out? Well, I can spot a higher low here. Now we may be in an uptrend. What do we need to confirm that? We need a higher high, and it looks like we have it just up here. And what do we see happening from here on out? We see higher lows and higher highs. This is clearly an uptrend on the daily. And if we'll notice, a lot of our higher lows occur at areas where we used to have highs. This is again reinforcing that concept of SR flips. It's crucial that we learn to identify these in real time in order to analyze the type of market we're in. Now, what do you think happens if we break it down a bit and we zoom into the 1 hour time frame? What might we see? Well, here I actually see a downtrend within the larger uptrend. Let's map it out. Here we have our high, and here we have our low. And if we notice now, From here on out, we have lower highs, lower lows, lower highs, and lower lows. But down here is what we have a clear indication of seller exhaustion. Sellers are no longer able to push the price lower. And what ends up happening is buyers effortlessly push it back up and set a higher high. This is known as a break in market structure. We'll go over that in the next module, so hang tight. The key to remember here is that trends are finite. Nothing lasts forever. So let's circle back now and do a quick recap before we move on to the next lesson. Uptrends are defined by higher highs and higher lows, while downtrends are defined by lower highs and lower lows. If we don't see either of these distinguishing features, we can't assume we're in any kind of trend. Lastly, it's essential that we use our trend identification skills to analyze what type of market we're in order to trade in the right direction. And since we just said that nothing lasts forever, we can never assume a trend is going to continue indefinitely. Assumptions are very costly when it comes to trading. In the next section, Trip will be going over the trendless markets, ones that don't have any of the distinguishing features that we just talked about. These are called range-bound markets. Thanks for watching, and I'll see you soon.